Welcome to the deep dive. Today, our mission is really laser focused. We're aiming to provide investment intelligence specifically for you, the investor who's looking for stability, for ways to manage inflation, and of course, for durable income.
Exactly. We're cutting through all the noise, all the headlines.
Right, to find out where that reliable long-term growth is actually hiding. And just as importantly, we need to talk about the risk. How do we handle this persistent headache of sticky inflation? And is this huge AI spending wave a real revolution or just, another bubble we need to dodge?
And to guide this deep dive, we've got a really formidable stack of sources. We've pulled insights from major global research houses, JP Morgan, Stifel, Fidelity, Deloitte.
The big names.
The big ones. And crucially, we've paired those macro forecasts with hard real-world data from regulatory filings. You look at the capital plans for Microsoft, for instance, and it's just astonishing.
And there's a common theme running through all of it, right?
There is. They're calling it multidimensional polarization and gravitational shifts. It really defines the whole 2026 landscape.
Okay, multidimensional polarization. Let's unpack that because that sounds complex. It suggests things aren't moving together, they're splitting apart.
That's it, exactly.
So what's separating here? Is this just about valuations, or is it something more fundamental about who can actually make a profit and who can't?
It's much deeper than just valuation, and that's what makes this whole environment so challenging, but also so rich with opportunity. This polarization, it describes a world where the market returns are splitting along several different fault lines.
Okay, like what?
Well, you've got the huge infrastructure spenders on one side and then, well, everyone else. You've got developed economies whose monetary policies are decoupling from each other. And maybe most critically, you see a split between companies that master what we call execution velocity, basically, the speed of learning, and those that fall behind.
So for you, the listener, the goal is to figure out how to navigate that chasm.
Precisely. And the overall outlook for 2026 is, believe it or not, remarkably positive. JP Morgan, for example, is forecasting double-digit gains for global equities. That's both developed and emerging markets.
But, and I'm guessing this is the catch.
The catch is that all of that optimism is highly intensely concentrated in just a handful of winners.
So if I'm hearing this right, we're really exploring two huge, very distinct investment themes today. On one hand, you've got this massive concentrated AI mode that's driving almost all the performance.
The main engine of growth.
And on the other, you've got this whole environment that's sensitive to interest rates, it's complicated by geopolitics, and that's where we have to figure out where to find stable income and how to manage all these external risks.
That is the essential roadmap for today. And before we jump into the explosive growth of AI, we really have to anchor ourselves in that economic bedrock, because managing inflation and understanding the rate environment is just paramount for anyone relying on income and capital stability.
All right, let's do it. Let's unpack this macro picture. What's the economic baseline we're starting with for 2026? Are we looking at a soft landing, or is there still a high risk of a recession?
The baseline, according to all the major forecasts, is one of resilient global growth.
Resilience.
Yes, and they point directly to things like significant front-loaded fiscal policy, government spending across major Western economies. That's really propping things up.
So that spending is acting like a buffer.
A powerful buffer against any slowdowns. But, and this is a big but, while the outlook is solid, we absolutely cannot ignore the downside risks that are still out there.
That's the key detail, isn't it? Because resilient definitely doesn't mean guaranteed. If the consumer is healthy and spending is strong, why is there still this lingering risk of a recession? Where's the disconnect?
The disconnect is partly in sentiment and partly in, well, external rate dynamics. Here's a critical piece of data. JP Morgan is forecasting a 35% probability of a U.S. and global recession in 2026.
35%. So more than a 1 in 3 chance. This is not a small tail risk.
Not at all. It's not the base case, but it's huge. And that risk comes from things like weak business sentiment, potential missteps by central banks trying to wrangle that sticky inflation, and of course the vulnerability of supply chains to geopolitical shocks.
So as an investor, you have to ask yourself, how do I build a portfolio that can handle a 1 in 3 chance of a downturn, even when the consensus is growth?
That's the question.
Okay. But if that base case does hold, it sounds like it's being powered yet again by the American consumer.
They are absolutely the foundation. The U.S. consumer is more than 2/3 of GDP, and thankfully they are still robust.
And what's keeping them so strong?
Sources like Stifel point to a few things. First, a healthy labor market. Second, Rising real income, so wages are finally beating inflation for a lot of people.
Yeah.
And third, you have the wealth effect.
From housing and the stock market being up.
Exactly. People feel richer, so they're more willing to spend. That combination of healthy balance sheets and plenty of liquidity is a pretty significant tailwind that we expect to continue through 2026.
So let's zoom in on that labor market. I remember the big story in 2025 was that things were softening, job growth was stalling out. What's happening now?
The dynamic is shifting, and this is really key to the whole inflation picture. Economists are talking about a necessary recoupling of the labor market with overall growth.
Recoupling.
Yeah. After job growth pretty much stalled in 2025, we're expecting hiring to recover. And when that happens, weak labor supply is going to take center stage again, and that leads to the market tightening back up.
Weak supply. Now, why is the supply side of labor constrained if the economy is picking up?
It's largely down to policy shifts. Across most of the advanced economies, the US and Europe included, immigration policies have changed and really limited the number of new workers coming in since the pandemic.
But it's a structural bottleneck.
A huge structural bottleneck. So if job growth rebounds against that constrained supply, wages get pushed up again. And this shift from softening back towards tightening, that's a key reason why inflation is looking so sticky for 2026.
Which brings us right to the main event for so many investors. Inflation. If you're focused on preserving purchasing power, especially in retirement, this is the core enemy. So let's unpack why everyone is calling it sticky.
The term sticky is everywhere because it means that even if inflation is lower than the peaks we saw, it's staying above the central bank targets. It's resistant to coming down quickly.
And that's driven by the two things you mentioned, goods prices and labor supply.
Exactly. You have continued pressure on goods prices from these more complex, more expensive supply chains. And critically, you have the weak labor supply we just discussed, which fuels wage pressure. Unlike a temporary spike in inflation, this sticky kind requires central banks to hold rates higher for longer to really stamp it out.
So if inflation is sticky pretty much everywhere, what does that mean for the dream of all central banks cutting rates together in harmony?
That dream is dead. We are looking at monetary policy decoupling. And this is a crucial concept, especially for anyone in fixed income. The bottom line is that sticky inflation limits the ability of most central banks to cut rates by very much.
The divergence is pretty stark, I take it.
It is. It highlights that polarization we mentioned right at the top.
So let's look at the major players. What's the outlook for the Federal Reserve here in the U.S.?
The Fed is expected to be pretty much done with its easing cycle early in the year, maybe another 50 basis points of cuts. They can do that because the U.S. economy, while strong, did show signs of slowing wage inflation a bit earlier than other places.
And the rest of the developed world?
Most other developed market central banks are expected to just stay on hold or maybe finish up any small easing very quickly in the first half of the year.
But there's a big outlier internationally, right? It sounds like not everyone is playing from the same sheet music.
Not at all. The Bank of Japan is marching to a completely different drum.
Why is that?
Well, they're coming out of decades of deflation. So they're actually expected to hike rates by 50 basis points. They're trying to lock in positive, stable inflation, the very thing everyone else is trying to suppress.
So this really is a multidimensional policy environment. There's no single global story.
None whatsoever.
Okay, so if we're not expecting big, coordinated global cuts, what's the actual forecast for bond yields? Should investors be positioning for a big bond rally?
JP Morgan's projection suggests a major rally is, well, unlikely. And this is a key takeaway for anyone focused on stability. Developed market yields are forecast to actually grind higher through 2026.
Higher, so what are the numbers?
Specifically, they see 10-year treasuries hitting 4.35% by the fourth quarter, and you see similar moves elsewhere. 10-year German bonds at 2.75%, and 10-year UK gilts all the way up at 4.75%.
If yields are grinding higher, that means bond prices are going down, or at least not going up, so capital gains are off the table. For that stability and income-focused investor, what's the actionable insight here? Where's the value in fixed income?
The insight is that your strategy has to shift. You're no longer seeking capital gains. You have to maximize what we call carry opportunities.
Okay, let's define carry for everyone.
In simple terms, carry is just the income, the interest you collect from holding the bond. If yields are expected to rise slowly or just stay stable, then the high coupon payments you're receiving offer a predictable stream of income.
So you're collecting the coupon, and that's your return.
That's your return. And that's why you look at markets like the Euro area or Sweden, where the central banks are expected to stay on hold. They offer attractive yields, the carry without the big risk of prices falling, allowing you to capture that income reliably. We're shifting from a capital appreciation mindset to a carry and income mindset.
Speaking of income, let's turn to credit. High-quality corporate bonds are a staple for a lot of people.
Mm.
What's the health of that market look like? Any worries about defaults?
The overall picture is described as okay-ish.
Chuckles. Okay-ish?
Hmm?
I like that. Confident, but not euphoric.
Exactly. It's benefiting from that resilient economy we talked about and slightly lower inflation. So defaults should remain manageable, especially in investment grade. But there are some dynamics that are expected to put a little upward pressure on spreads.
Spreads being the extra yield you get for taking on credit risk.
Correct. The premium you earn over a risk-free treasury bond. And that pressure is coming from supply.
A lot of new corporate bonds hitting the market. Why is that?
Precisely. We're expecting a notable pickup in net issuance. Some of that is from classic corporate activity M&A, leveraged buyouts. But a huge wave of new supply is coming from the AI ecosystem.
Oh, so they're issuing bonds to build all this new infrastructure.
Exactly. And when all that new supply hits the market, if demand doesn't keep up perfectly, spreads have to widen a little bit to attract buyers. The price of risk goes up.
So within that credit world, high grade versus high yield. Which is the better bet for 2026?
The sources, like Fidelity, suggest that high-grade credit is expected to outperform high yield. And it's not really because of a big default scare in high yield. It's about a concept that's critical for our listeners.
Duration.
A bond sensitivity to interest rates.
Right. High-grade bonds have a much longer duration. So if the strategists are right and bond yields are going to rise slowly but persistently into 2027, the longer duration bonds are actually better positioned to ride that out without too much volatility. They offer slightly better risk-adjusted returns.
Let's pivot quickly to emerging markets. With the U.S. economy strong, but the global rate environment all over the place, does that help or hurt EM assets?
Actually, the macro backdrop for emerging markets looks more supportive and less volatile than it has in the past few years.
That's surprising. It is. JP Morgan is generally constructive on EM local markets, their currencies, and their high-yielding local bonds. The reason is that EM central banks were way ahead of the curve in hiking rates. Their inflation has been falling for over 2 years now, leading to positive real rates in a lot of places. That high carry is very attractive.
But what's the big risk? Historically, EM seems so vulnerable to whatever the U.S. does.
And that hasn't changed. The primary risk for EM doesn't really come from EM itself. It's almost entirely from the U.S. rate environment. If U.S. growth and inflation come in hotter than expected, and that leads to high and volatile U.S. interest rates.
Because the Fed has to get more aggressive.
Right, or is perceived as not being aggressive enough, causing the long end of the curve to spike. That scenario is like a vacuum. It just sucks capital out of EM bonds and hurts performance across the board.
So if macro inflation is sticky, the only real structural relief has to come from somewhere else. And that brings us directly to the AI infrastructure revolution. This is the biggest story in the market, the thing defining the positive outlook for 2026. This is where that multidimensional polarization gets really vivid.
It truly is. We are talking about a fundamental shift that is, it's historically unprecedented in its speed and its concentration of capital. This polarization means that if you're not invested in this core group, your equity portfolio might be completely missing the main engine of global growth.
Okay, let's start with the scale of this AI moat. Who exactly are we talking about here, and how big is their footprint?
We can define this core AI group, the Moat, as just 8 stocks. You have the 4 hyperscalers, Amazon, Google, Meta, and Microsoft.
The cloud giants.
Right, plus the critical hardware providers, Nvidia, TSMC, AMD, and ASML. These 8 companies collectively represent an astounding 20% of global equity market capitalization.
20% from 8 companies.
To put that in perspective, they were worth about $3 trillion back in 2018. Today, they're worth over $18 trillion. That is a 6-fold increase in market value in just a few years, all driven by this AI dominance.
That is staggering. And the amount of money they're spending to build this must be just as massive.
It's not just massive, it's a capital expenditure tsunami. The sources all highlight this as a defining feature of the 2026 economy. Just the 4 hyperscalers alone have spent $1.3 trillion in CapEx and R&D since the 4th quarter of 2022.
Which is right when ChatGPT launched and this whole thing kicked off.
Precisely.
Okay, I need to hear the analogy the sources provided because that number is hard to grasp. This is where it gets really fascinating.
It is genuinely hard to wrap your head around. So to quantify it, in the first 3 quarters of 2025, tech capital spending accounted for between 40 and 45% of all U.S. GDP growth.
Not total GDP, but the growth.
The actual increase in output. Now, for the historical context, the tech capex spending in 2025 alone was equal to the sum of peak spending relative to GDP at the time on several monumental projects combined.
Okay, which projects?
Think of the interstate highway system, the Apollo project that put a man on the moon, the electrification of farming, the Manhattan Project, and several of the big FDR public works projects.
Hold on. You're telling me that the tech spending in 1 year equals the combined historical cost of the Apollo project, the Manhattan Project, and the entire interstate highway system, adjusted for the size of the economy back then?
Yes, all of them combined. That is a genuinely shocking number.
What does that even imply? I mean, when capital is deployed at that scale, it suggests this isn't some short-term cycle.
It implies this is not a flash in the pan. Those were nation-defining foundational projects. It means these companies are embedding an entirely new economic infrastructure, a global AI factory, into the bedrock of the economy. This level of spending suggests they're anticipating a return on investment that must be generational in scope.
Well, that scale naturally leads to the elephant in the room. With valuations hitting these levels, are we in a 2000-style tech bubble? Have the numbers just completely detached from reality?
That's the most important question for any investor right now. And the data, especially when you adjust for future earnings growth, suggests that the market's pricing shows internal coherence. It's not pure speculative hysteria, at least not for those core 8 stocks.
So we need to look beyond just the simple PE ratio.
You have to. You need to look at the PEG ratio, the PE ratio adjusted for expected earnings growth.
Right.
And when you look at the PEG ratio for the global tech sector, it's priced pretty much in line with the overall market. So yes, investors are paying a premium for growth, but it's a premium that reflects a verifiable expectation of that growth. JP Morgan estimates this AI supercycle will drive S&P 500 earnings growth that is 13 to 15% above its historical trend for the next couple of years.
So we're paying for exponential growth, but those expectations are backed by that staggering capital spend we just talked about. But who is actually capturing this growth? Is it trickling down? The sources seem to suggest the benefits are very concentrated.
And that is the most critical distinction for investors. The benefits are extremely concentrated right now. You can think of potential beneficiaries in 3 buckets.
Okay.
Bucket 1, the infrastructure trade, selling the picks and shovels chips, cloud services. Bucket 2, companies selling AI-related products and services. And bucket 3, companies benefiting from internal productivity gains.
And what's the market telling us about those 3 buckets?
Only the first bucket, the infrastructure trade, is really doing well and driving returns. The other 2, the companies selling AI products and those supposedly getting immediate productivity boosts, they've been relatively flat compared to the broad market since this all started.
So that confirms the polarization. Outside of that core infrastructure layer, it's still a stock picker's game.
Absolutely. It is not yet a broad-based rally. Investors are funding the foundation, but the rest of the house hasn't really been built yet.
Let's zoom in on the undisputed king of that infrastructure. Nvidia. Their dominance is just almost unbelievable.
Their market control is astonishing. It really speaks to the power of their ecosystem. In 2025, Nvidia controlled 92% of the GPU market. They hold over 80% of the entire AI hardware market. And that's not just the chip, it's their software, CUDA.
That's the software lock-in.
A tremendously strong and sticky software lock-in. It makes it prohibitively expensive and time-consuming for their customers to switch to a rival.
And how are they staying ahead on performance? Surely competitors are catching up.
Their advantage is compounding. That's the definition of a deep moat. They just unveiled their new Rubin data center chips, and the key spec they emphasized wasn't just speed, it was efficiency. They claim the new chips are 40% more energy efficient per watt.
And that's huge because power is becoming a real bottleneck for these data centers.
A massive competitive advantage. By offering better performance per unit of energy, Nvidia strengthens its position immensely.
So the analysis is that their leadership is maturing, not peaking. What does that mean for the investment outlook?
That's the exact conclusion. The slowdown in their valuation looks more like maturation, a natural result of their extreme size, than it does exhaustion. The market still sees a lot of room for growth. The average price target is about $260, which is 36% above its current level of around $191.
Next up, let's talk about the company maybe doing the most to actually integrate and monetize AI across the enterprise, Microsoft.
Their whole corporate strategy now is built on 3 pillars: security, quality, and AI innovation. They understand that for these systems to work at a global scale, they have to be trustworthy.
And their infrastructure commitment. What do the numbers say about their physical build-out?
The commitment is truly unprecedented. In 2025 alone, Microsoft added over 2 gigawatts of new capacity across their data centers. That is enough to power a small country. There are now over 400 data centers in 70 regions. And they announced a new facility, Fairwater, an AI data center in Wisconsin, that will deliver 10 times the performance of today's fastest supercomputer. They've committed $32.1 billion just for new data center construction going forward. They are building the global AI factory floor.
But that infrastructure only matters if they can turn it into products people will pay for. How are they monetizing this?
Through the Copilot family. It's already surpassed 100 million monthly active users, but the key innovation is something they call agent mode. This is the leap from AI being a helpful assistant to being a functional employee.
Okay, give me an example. How is agent mode different from just asking a question?
Think about a business user. Instead of asking Copilot to summarize a spreadsheet, you can give it a much more complex prompt, something like, run a full analysis on this sales data, figure out the key insights on our weakest product line, and then format it for the exact team and make it visual.
And agent mode does all of that on its own.
It takes charge. It decides which formulas to use. It creates new analysis. It cross-references other data. It builds the charts, all orchestrated from that one single command. It's a huge leap in white-collar productivity.
For our senior investor audience, capital stability and returns are just as important as growth. What's Microsoft doing on that front?
This is a crucial area where they really shine. They have a robust commitment to returning capital to shareholders. In fiscal 2025, they declared $24.7 billion in dividends.
And share buybacks.
They're operating under a massive, ongoing $60 billion share repurchase program. This commitment to both investing in future growth and providing substantial, consistent capital returns, it makes a powerful argument for its quality stock designation.
Now let's look at Apple, the final piece of this puzzle. They present a really fascinating and maybe troubling paradox in this AI era.
They absolutely do. On one hand, they have an impenetrable defensive moat. Customer loyalty is at 92%. They have 2.35 billion active devices out there. Their services division alone makes up half their profit. Financially, it's a fortress.
That sounds pretty solid. So where's the vulnerability?
The vulnerability is strategic. It's in their crumbling offensive moat. CEO Tim Cook has confirmed they will not compete in creating core large language models. They seem to accept AI as a commodity, something they can license from Google or OpenAI to run on their devices.
So they're choosing not to build their own core AI capabilities.
And we can see the tangible evidence of that choice in the data. Look at the CapEx spending. Apple's is stubbornly low, around $4 billion a year. Compare that to their peers spending $40 to $80 billion a year building AI infrastructure.
The conclusion from that is pretty stark.
It is. The analysts conclude that Apple has made peace with being a hardware provider for delivery of others' innovation. And that raises a huge risk about their position in the next computing paradigm, where the value is shifting from the device itself to the intelligence delivered through the device.
So the question for investors is, if they're just a utility pipe for other people's innovation, does their premium valuation still make sense?
That is the multi-trillion-dollar question.
We've established that global inflation is sticky. For the investor trying to protect their retirement funds, this is vital.
Yeah.
Where does the relief come from? How does this massive AI investment actually create structural, lasting deflation?
The deflationary power is immense, and it comes from operational deployment. AI agents and automation just fundamentally lower the corporate cost curve. They replace repetitive, high-volume tasks, and that creates a lasting efficiency that buffers against that sticky wage inflation.
Give me some concrete examples of that.
A great one is from manufacturing. A global manufacturer, Danfoss, is using AI agents to automate order processing. They've automated 80% of transactional decisions that humans used to handle.
And what did that do to their efficiency?
It cut their average customer response time from a staggering 42 hours down to near real time. That's not just better service, that is operational deflation being realized.
That's white-collar automation. What about physical goods and logistics?
We're seeing huge deflationary pressure there, too, from robotics. Take Walmart's $520 million investment in Symbotic. It's to automate their pickup and delivery centers. They can scale up throughput exponentially without a proportional increase in headcount. That directly curbs wage inflation.
And the projections are pretty big for the whole sector.
Industry analysis projects broad robotics adoption could cut logistics costs by up to 40% and boost productivity by 25 to 70%. These are massive, permanent gains.
Even in something as bureaucratic as global trade.
Absolutely. We're seeing it with things like blockchain and smart contracts, reducing administrative overhead. The Digital Container Shipping Association estimates $6.5 billion in direct savings just from adopting electronic bills of lading.
So it's cutting out the paperwork and the friction.
AI cuts bureaucracy, and bureaucracy is an inflationary friction.
So if efficiency is the goal, how do investors spot the winners in this race? The sources suggest it's no longer just about who has the most data.
That's the pivot. The new competitive moat is what's called the feedback flywheel. It's a compounding data network effect where the product gets better with every single use. The winner is the one who learns the fastest.
How does that flywheel actually work?
It requires a massive ongoing investment in MLOps machine learning operations. The flywheel has 3 steps. Step 1 is collecting data, both implicit feedback, like what a user clicks on, and explicit feedback, like a rating.
Okay.
Step 2 is instant analysis. That flood of real-time data is used to refine and update the model. And step 3 is redeployment. The improved model is instantly and continuously pushed out to all users.
So the speed of that loop must be the real advantage.
It is the primary competitive advantage. We call it execution velocity. It's the speed at which you can gather feedback, refine the model, and redeploy it. If the leader can iterate daily while a competitor only iterates quarterly, the quality gap becomes unbridgeable within months.
So as an investor, how do I measure a company's execution velocity? What should I be looking for?
Well, you can't see their code, but you can look at where they're putting their money. Watch for companies allocating huge capex to MLOps tools and infrastructure, not just buying chips. Listen for management talking about deployment frequency and time to insight. High velocity means high compounding returns.
Now for the critical flip side, this AI growth creates enormous new demands. What new costs should consumers and businesses be bracing for? This hits household budgets directly.
There are 2 major rising cost centers. The first one is energy. It's a structural bottleneck. Training and running these models is tremendously energy intensive.
How intensive are we talking?
OpenAI's long-term targets for 2027 require 30 gigawatts of power by 2030. That's an amount of infrastructure that doesn't exist yet. So utilities have to transform to meet this demand, and that capital investment will inevitably lead to upward pressure on our utility bills.
And the second cost area is more direct. Subscription inflation.
This is a straight price shock, and Microsoft is the prime example. They're passing AI costs directly to users. It's the first major price increase for their consumer bundle in 12 years. The Microsoft 365 personal plan went up by 45%, from $109 to $159 a year.
45%. I suspect a lot of our listeners felt that one personally when they saw their bank statement. That's not sticky inflation. That's a price shock from a monopoly platform.
It's a significant hit, and it affects businesses too. Teams phone standard is up 25%, Power BI Pro up over 16%. And there's a nuance here too. Flexibility costs more. The new monthly billing plans are 5% more expensive than paying annually.
So they're monetizing not just the features, but the payment structure itself.
Exactly.
We've covered growth and income. Now we have to address the major global risks policy and geopolitics. This is crucial for any investor seeking capital preservation. Let's start with the policy shifts expected under the new U.S. administration.
Stifel's outlook suggests the theme for 2026 in Washington will be less government and deregulation. That typically benefits sectors like energy and financials. However, the agenda breaks sharply from historic Republican positions in 2 key areas: trade and antitrust.
Let's focus on tariffs. That's a profound shift. What's the scale of the threat here?
The scale is immense. The new administration is pursuing tariffs, and Mr. Trump specifically threatened a 60% tariff on all Chinese imports.
60%. When could that happen?
The expectation is that the process will begin in early 2025, with implementation likely in mid to late 2025. This is an existential challenge for any company reliant on China for manufacturing or sales.
Which industries are most vulnerable to that kind of shock?
Consumer electronics, certain auto parts, anyone deeply integrated into Chinese final assembly would get hit first. But the most damaging effect could be the secondary inflation. Tariffs are taxes, and importers will pass that 60% increase through. That could reignite goods price inflation all over again.
So it just compounds the sticky inflation problem.
Yep.
And what about on the domestic front? Antitrust. Will the tech giants have an easier time now?
Interestingly, no. There's a populist skepticism about consolidation in both parties, especially in tech and healthcare. This suggests that the ongoing antitrust enforcement actions we've seen are expected to continue. The new administration is not expected to just give the private sector a free pass on M&A.
Moving to geopolitics, the most pressing risk still seems to be the China-Taiwan dynamic, especially because of semiconductors.
This is the most complex risk factor. China is focused on building its own domestic supply chains for national security. Their bronze strategy is to string more older, less efficient chips together into massive clusters. They're willing to absorb much higher power costs to just try and achieve computational parity.
How big is that technology gap still?
It's still heavy. The vast majority of chips used to train Chinese AI models are still Western chips. China has capacity for older chips, but very little for the advanced ones, and their current generation of chips from Huawei requires more than double the power per unit of computation compared to what Nvidia is offering.
And what makes Taiwan itself so acutely vulnerable?
It's their extreme dependency on imports. Taiwan imports 90% of its primary energy, mostly fossil fuels. If those sea lanes are interrupted, the power goes out, and you can't make advanced chips without a constant power supply.
It's not just energy, is it?
No. They're also in the top 10 globally for food imports as a percentage of their supply. Any conflict triggers an immediate energy and food crisis.
So any disruption, even a temporary blockade, would be devastating. And what's the military posture look like?
It reflects that sustained tension. At the end of 2025, China had between 60 and 100% of all its military assets deployed in the Taiwan Strait area. That includes 100% of its amphibious assault ships.
So a state of very high readiness.
Exactly. No one can predict war, but those data points show the magnitude of the risk that has to be priced into portfolios.
Finally, let's bring it back to the investor focus on preservation and diversification.
Mm.
Beyond the AI moat, what do the non-equity markets look like?
For fixed income, as we discussed, the focus is all on carry opportunities. We talked about the euro area, Sweden, and emerging market fixed income, local bonds, and FX also remains relatively constructive because of those high real rates.
What about tangible assets? Commodities as an inflation hedge, specifically agriculture.
In ag markets, the outlook is mixed. The analysts are bullish on corn and wheat, but bearish on soybeans. The key driver of volatility here is something called stocks-to-use ratios.
Okay, let's clarify that jargon. How should we think about stocks to use?
It's a simple concept. It's the inventory you have on hand, the stocks divided by the total annual demand, the use. It just measures your supply buffer.
And that buffer is low right now.
The projections for the next couple of seasons show these ratios remaining near historically low levels. A low buffer dramatically raises price volatility. If there's a supply shock, like a drought in the Midwest or Ukraine, the global system has no reserve to fall back on, and prices can spike dramatically.
So low stocks to use equals high volatility. That's a clear signal. And as a final note on equity strategy in this polarized world,
Fidelity stresses that investors must prioritize quality stocks. This is critical. Quality means best-in-class companies, like the core AI players, but also resilient companies outside the moat. Look for high free cash flow to revenue, low debt, high margins. These are the companies that can weather the risks we've talked about.
so if we look back at the 2026 landscape we've just mapped out, it's really defined by this intense dichotomy. You have robust growth, but it's led by this incredibly concentrated AI build-out.
And that's offset by persistent, sticky inflation, rising consumer costs, and that huge geopolitical risk in the supply chain.
The year ahead is really a balancing act then.
It truly is. It requires tactical precision. For you, the investor, the core strategy is balancing the growth of the future, investing in those core AI leaders and the companies with high execution velocity with the protection of the present.
And protection of the present means actively building a hedge against all these macro risks.
Exactly. Hedging against inflation with the right assets, leveraging AI's deflationary power. It means positioning your fixed income for carry, not capital gains, and focusing only on quality companies with strong cash flow.
Because passive investing outside that core AI moat is just getting riskier. Stock picking is vital.
Absolutely. Which leaves us with a final provocative thought for you to consider. We've talked about the two obvious buckets of AI winners: the infrastructure sellers like Nvidia and the hyper-efficient corporations like Walmart. But think about the third bucket.
Go on.
If AI agents successfully automate security operations and customer service, slashing fraud and labor costs, which traditionally labor-heavy sector, beyond tech, is structurally positioned to get the biggest margin boost purely from embracing this new deflationary technology. Think about sectors with a huge labor share of sales, like finance or healthcare. How could their profitability fundamentally shift once these agents are deployed at scale? That's the next great opportunity to explore.